新的面孔，对吧？以前可能是比较最近才来的。If there's anything, feel free, I can explain. 今天主要谈的问题呢，我认为是现在最重要的经济和金融投资问题。就是这个全球，首先是美国会不会进入这个 stagflation 这样一个 period？ 那我们先要来看看怎么样定义这个 term. It's a very loose, popular, but not very well defined term. People talk about it a lot, but 就是说我就想试图给大家这个提供一些背景吧，然后呢，我们再看一些宏观经济的数据，然后看看能不能我们把自己的所听到的新闻这个financial news、economic news 来给大家一个比较 coherent 的一个 picture 然后呢，我们来进一步的讨论一下我们现在所主流的观点是什么，然后呢，有一些非主流的观点是什么他们之间 debate 到底在 debate 些什么问题 ，and how we should think about this problem going forward, which could give us some indication as to how you want to put your money where globally, or in what sector, and whether or not you should hold your cash or you should commit to certain area. 首先我想问一下，因为今天呢要谈的这个问题，大部分这个主题都是宏观经济学的东西，不知道大家是不是对这个 topic 是比较熟悉，有没有上过宏观经济学？我们看看有几个，就是说要对这个里面的一些基本概念要多深入的去探讨。如果是大家都知道，那我们就是流水线一样的一带而过。如果碰到一些比较重要的概念，你们可以打断我一下那么我想呢，在一开始的时候想讲一讲上一次我讲的那些演讲里边的一些内容，然后呢，这个连带着待会呢，我主要就不再涉及这个中国方面的东西，但是呢，后面呢做 conclusion 的时候需要提到中国方面的东西。上一次呢，你们如果来过的话，记得我就把这两个 portfolio， 一个是 FXI， 一个是XLF。前面 FXI 是中国的大的银行和企业组成的一个 portfolio， 是一个 ETF， 你可以 trade， 你可以 short， 你可以 buy，OK？ 他们过去10年来，他们的之间的这个 performance return 之间的差异看起来越拉越大。那么我当时就问了一个问题：这个趋势会不会仍然继续？那接下来10年，他们之间的差异会不会越拉越大，还是说会缩小，会 converge？OK？ 然后呢，就进行了一些分析。那么我们这个上一次的 conclusion 呢，就是说中国的情况看起来不是很乐观，甚至可以说相当糟糕，因为呢有很高的债务，有这个经济结构里边的一些重要的问题 ，OK？ 那么我的 conclusion 就是说，这个差异可能继续扩大，这是去年10月份的一个小小的结论。那么从去年10月份到现在，差不多有1年了。1年这两个 ETF 之间的走趋势来讲，这个是 FXI， 仍然是在往下走今年呢，因为有战争一开始因为有俄乌战争嘛，一开始其实我们并不能很明确的知道他们这个相互之间的影响是怎么样的。这个 XLF 是美国的，主要是美国的大银行。主要的是美国的这个 global banks 的 portfolio， 那么它的 performance 也不大好，但是呢，要比这个要好很多，好不少，所以这个差异仍然在扩大，所以明年我们还可以 come back and revisit 这个 same issue， 就是说相当于这两个 portfolio 之间的差异呢，相当于证实了so far 证实了我原来的一个看法，就是说中国的这个宏观经济的走向看来是越来越不对劲，必须要有一个 turnaround 才行，相对于美国来讲 ，OK。那么今天呢，我们就继续探讨这样一个问题，就是 U.S. stagflation， 我们怎么样看待问题 ？OK。When people talk about stagflation, usually the image that you have in mind is not the Great Depression in the 1930s. It's not the last financial crisis of 2008 and 2009, but rather is a picture that you should have is what happened during the entire decade of 1970s. 就是70年代，上个世纪70年代，70年代的总统是谁？大家知道吗 ？Nixon and then who? Ford. Yeah. Nixon 最后 resign, Ford take over. 然后呢 ？After Ford is Carter. So those people is should come into mind. 然后 another important player during those decades, 1 decade long of economic up and down is the Federal Reserve Chair. Federal Reserve Chair, I think it was Arthur Burns, was initially long period of time, and then it changed to another guy, I forgot his name. And then Paul Volcker is the name that you should probably remember, because he's the guy eventually stopped the inflation. So we're going to try to review what happened during the 1970s, and that's going to be our benchmark, our reference. When people talk about stagflation, that's the period of time that came into mind. And I'm also going to show what we are seeing now during 2021, 2022, bears certain similarity to 1970s, but it's very different. The picture that we are seeing now is very different. How different? Because it's very different, the way that the policymakers or the government should react to it should be different from the last period, from the 1970s. So, which also going to give us certain confidence that maybe this time is truly different, that the Federal Reserve and the government are doing something that they have learned from the history. They're going to do the right thing this time. That may, if that's true, that may give us confidence as to how well this could be under control, right? At least for U.S. And I'm going to show some evidence that maybe U.S. is in a better shape than China, than Europe, which will allow U.S. to lead us out of this potential trap that we call stagflation. Maybe we're just going to have a short period of stagflation and then we'll be out of it. But for other countries or other economic entities, you may not be so lucky. So that's the gist of my talk. And then I'm going to try to spend some time on different views, mainly from macroeconomists. Okay? There's a certain group of people what we call policy hawks. They want to jack up interest rate as high as possible, trying to kill the economy to growth so that we can cure inflation problem. There's a certain group of people, we call them doves, because they want to go a little easier, not too aggressive. And then there are a bunch of people somewhere in between. Outside of these three groups, there are certain type of investment gurus. Most of them I'm just going to ignore because they're viewed like bouncing up and down everywhere. You can't possibly follow them to what they're talking about. So let's begin with some background information. Okay, stagflation before 1970s. This was not an issue. Okay. 当时的经济学比较 established 的经济学是凯恩斯这个经济理论。So the Keynesian approach to the economy is that the government can take on a very active role to manage the economy. So if the economy looks kind of weak, the government can promote it so that recession, inflation is a trade-off, but you can manage it. So there was an established relationship. People think it was kind of stable, inverse relationship between inflation and unemployment. Both of these, inflation you can measure it by what? How do you measure inflation? Within the economy. Yeah, convention way to measure it is you form a basket of consumption goods and then you observe the prices, give them certain weights in between, and then keep track of CPI, how they go about change it every now and then, right? Every quarter, every year. And you can also measure unemployment by conducting surveys of how many people are working and so on, what kind of the jobs that they're having. So those two macroeconomic variables people keep track of, the government entity keep track of them. And you can then show through long historical data, they actually form something called Phillips curve. Over a decade, this relationship looks quite stable. Namely, if you plot the data like on x-axis unemployment, on the vertical axis inflation, they have a inverse relationship. So the logic is also quite clear. During expansion, okay, increase of demand should drive up prices. When you have an expansion, that business tend to hire more employees, therefore you have low unemployment, right? Conversely, during the recession, lower demand would then cause unemployment to rise, but people may not be buying so much things, therefore the price drop. This is very logical kind of relationship, but still it's empirical. There's really no microeconomic foundation for this curve that people observe being stable. However, the stability was broken down during the 1970s. We not only see long period of time of slow growth, sometimes it's fits and starts, sometimes it's grow somewhat rapidly, but it's basically stagnated. And then we also saw high unemployment, rising prices, and that relationship was called into a huge questions, which caused a revolt, basically, to the field of macroeconomics. So people, naturally propose new theory, 新的这个经济理论，新的宏观经济，在70年代的时候有一个很大的发展，可以说是当时是一个革命性的发展 ，revolution because of that problem。那么从数据上来讲，我这里受的是65年到85年的这两个 decades 的那个 annual data。The first graph is CPI, core CPI. Core CPI is what the Federal Reserve care most about, the core inflation. What is defining core? Core is from the CPI, when you take out the energy and food, those tend to be more volatile. You have then the remaining part is called core. Okay? So what you can see here from 1970 to 80s, relatively speaking, you have a high CPI core. This is 10%, right? This is 5%. Right now, as we speak, the core is about, right now, 6.2%. It's somewhere in between. But if you have year after year of that kind of number, that's basically is an inflationary environment, right? 然后你看 unemployment 呢，70年到80年unemployment is also regularly over 5%. And if you look at the GDP, the growth picture from 70 to 80, there's some growth that is about 5%, but you can also see some really low numbers. Right? So that was not a pretty picture for the 1970s. Now what happened was people go back and try to understand what caused them, what caused this kind of stagnation along with inflation. Okay? So there was a problem with debt build-up during the 60s, expansion, the war, and so on. So when you have to manage debt, there could be potentially a huge problem. But more than that, and which also shares some similarity to what we are seeing now, is oil shock. Oil shock didn't happen in the early part of 1970s, but rather OPEC. Did you guys all heard about OPEC? It's a cartel of the oil-producing countries. They formed together trying to maintain a high price. At that time, this is the first time they just agree among themselves, we're not going to produce much oil, therefore the price jumped. That's 1974, in the middle of the 1970s. And then after that, early part of 80, they did that again. So oil prices have this huge shock to the US economy. At that time, US was very dependent on Middle East oil import. What we are seeing now, the kind of fracking business, the boom of 那个页岩汽油、油气井都是后来的事情。70年代的时候，美国还是相当进口相当多的这个石油。So the prices came as a supply shock, as a price shock into the economy. That obviously is going to cause a lot of inflationary pressure to the economy. Then people also, after the fact, also trying to pinpoint policy-wise there's a lot of mistakes. As I mentioned earlier, the administration went through certain changes. There was scandal, and on top of that, Federal Reserve itself, the Federal Reserve is supposed to manage the monetary policy, right? Never experienced this kind of problem. So sometimes they feel like they need to fight inflation. Sometimes they feel like they need to promote employment. So there's constant changes in monetary policy, not consistent. And two particular problems that people identify is that when you allow inflation to go on for a certain period of time, like number of years, then consumer and businesses starting to think in an inflation mode. People would project that inflation is likely to increase later. This has become an entrenched inflationary expectation. And that by itself is like self-fulfilling prophecy. People would push for higher wages, and business will have to accommodate that. And that creates a problem for policymakers, for the entire economy. It just seems to help perpetuate the problem itself. The other thing is, once you have that into the motion, that worker demand higher wages, and which again help the consumer demand, right? So it'll help push up the general prices. When general prices level goes higher, the laborers will continue to demand higher wages. So it becomes a spiral, an adverse spiral. So right now, every sensible macroeconomist are trying to be watchful, trying to watch these two problems. You don't want to get into an entrenched expectation. So earlier we talked about how you measure inflation, how you measure unemployment. There's also a way to measure expectation of consumers' expectation, how high the inflation is going to be next year, 2 years from now, 3 years from now. You can do survey, you can do consumer survey, you can do business executive survey. Okay, so there is a way to measure it, inflationary expectation. And that's also a way for the policymakers to monitor expectation. If you see the expectation spikes, that gives us a much higher warning signal. You don't want to repeat 1970, then you watch out for the inflationary expectation. And the second thing to watch out for is wage spiral, price spiral. If you see that the wage level keep rising, and you're still not able to retain your employee, and you have to offer them higher wages, and people turn it around and then buy a lot of stuff, which push up not only the consumer prices but also producer prices. And that's something else that people are watching very, very closely. Okay? So 70s give us a lot of interesting lessons, but are they the same this time around? This is a very long series of unemployment rate. Okay? Is unemployment number divided by available employees, people who are seeking jobs. Okay? Unemployment rate, normally you want to see unemployment rate to be as low as possible. That means full employment, everybody happy. You want a job, you get a job, right? That's where we are now at this point. Is it low or is it high? Right now it's actually fairly low. This peak, this spike was during early part of 2020. That was caused by the pandemic that we are just now getting out of. Now, if you compare that period to 1970 to 1980, during those one decade, how many cycles can you already identify? Right? At least 3 cycles you can already identify. In this business cycle, this is what we call business cycles， 就是经济周期啊。经济周期，我们以前学习这个政治经济学的时候，就是有什么复苏，然后是这个复苏以后是什么扩张，扩张之后是进入衰退，然后萧条，对吧？这个差不多有四个period。During 70s, you see unemployment rate spike initially, and then stabilize, and then go up even more, and then stabilize some more as the government try to fight unemployment, right? And in the early part of 80s, it spikes up again, and this is the time when Paul Volcker came into the Fed and then really increased the federal funds rate dramatically to fight inflation. The result of it is over 10% of unemployment. Right? The price you pay to fight really high inflation is widespread unemployment. Hopefully, we'll never have to get to this period. Okay. Now, in between is something rather interesting. What happened here? What happened here? That's the financial crisis. And it took us a long time, Obama years and then Trump years, to gradually decrease the unemployment rate to a level that you can consider full employment. And that also represents a long period of expansion, steady, low growth, but expansion nevertheless. So intervening period is kind of interesting. You're going to see in the next chart that something else that show up as very different. I can't go forward.
啊，你掉了。不好意思，让我看。
可能 disconnected. So I'm going to show. I think next graph is either prices or the interest rate. Those are all key macroeconomic variables. Okay. We can talk through about this as well. Unemployment rate, and then this is just okay. Can I go now? Okay. Okay, I can. Yeah, I can do it. This picture is just a different representation of the information in the previous picture. What you can see here is, this is the current cycle. This is the huge peak you saw earlier, the 2020 recession. What this shows, instead of unemployment rate, it is the job loss. Okay? So at the beginning of the recession of 2020 recession, huge drop in the job. So the job loss was huge, right? Because people cannot work and businesses were shut down because of the pandemic. But the recovery was also very rapid, and that's partially due to the fiscal policy that the government was able to inject into the economy, such as the Pandemic Recovery Act. Government just giving out money at the time. And then the job recovery also quite rapid. This is the point just a couple months ago. The government announced that all the job loss during the pandemic has been recovered. This is current period, okay? Now this is the last episode during a long expansion, but also a very painful financial crisis. It took a long time, many more years to get back to fully recover the job that was lost. However, it was not as deep, it's much shallower. But compared to 1970s, here's what happened. This curve, 74, when the oil shock happened, is this curve right here, right? It was much shallower during those times. So that's the picture that we have in mind. What we are now having is, seems to be the business cycle could get more severe, but more rare. Another aspect of the business cycle is the inflation measure that we can see in this picture. Okay, the dark line is the entire CPI index. Right now we're standing in August. Last measure was 8.3%, even though it dropped a little bit from 9.2% in July. But the market reacted very violently. That was because the core inflation number, which showed in the lighter line, 这个浅蓝色的这个是 core, okay? The core obviously is not as volatile as the complete CPI, full CPI, right? What happened during August was that the core actually increased. Instead of dropping like the full basket, the core prices actually increased a little bit. So that was counter to expectation of the financial market. And that was why the Fed has just decided last Wednesday, right, to increase the Fed funds rate another 75 basis points. And that was due to the core. Core prices is what the Fed is most concerned about, because the core basket of the CPI represents the more persistent part of the inflation measure. So now, another feature to look at, to examine is, during this long period of time, 1990s, 2000, 2010, the inflation measure basically jumping up and down, but not in a huge amount, except for during the financial crisis, right? The volatility is not that big, it's rather stable. So you see this gives the condition of longer expansion, but potentially deeper recession if it happens, right? Compare that to earlier period during the 70s. You see these spikes, right? When inflation went up so much, 这么高的 inflation 14%的话，就是经济是受不了。最后大家都 consensus was you have to fight inflation. We just entered a recession. 这个就是 Fed funds rate， 就是 Federal Reserve 能够 control the short-term interest rate. Right? The Fed is a very powerful entity. but it has very limited tools. It can affect the short-term rates of interest overnight. How banks deal, lend and borrow money at what rate? That's the rate they can set. Policy rate. The other thing is how much money they can print. That's another tool. Basically, only these two main tools. And the third one is how they talk, how they communicate to the market. Basically, that's the three things that they can play with, plus some regulation for the banks, for commercial banks, investment banks. Very limited tools. When you think about the macroeconomic picture, it has many variables, right? Inflation, unemployment, export, import, labor market, how people think, what the future is going to be like. So you can name more than 10 variables, easy. With 3 or 4 tools to target that kind of complex picture, it's not an easy task by any means. So the Fed have to identify what are the main tasks they have to accomplish using limited tools that they have. On top of that, the problem is, it's not like driving a car at all, that you press on the accelerator, the car will immediately pick up speed. When the Fed decides to increase the Fed funds rate, the pointer. Anyway, I'm going to talk through. So, I can't show.
刚才我问了一下
那个 pointer 没有了。
哦，对，那 pointer 好像用不了。
那就算了啊。
那好知道。
OK。但是起码这个可以。Okay. This is a very, this graph has a lot of information. Basically shows the short-term interest rate that the Federal Reserve get to control over many decades, from 1960 to current. Okay. 这个最后前些天加了0.75% 的 interest rate， 现在应该在这个里。Even after that interest rate hikes, we are still looking at less than 4%. Right? Historically, it's not that big, but it caused a lot of market panics. The problem I was talking about is coming to is that another tough issue for the Federal Reserve to wrestle with is, after you increase the interest rate, how long will it take to affect the real economy? There's a term called long and variable lags. There's a time lag between the time that they increase the effect of the interest rate and when its impact shows up in the economy, when you can actually measure. That lag, time lag, is a problem because you don't know how long it will take to affect the economy and how much. Given there's a series of spikes that increase, maybe there's an argument you want to wait a little bit until it shows up in the economy to hike another one. So, complex economy, limited tools, and that's what the Federal Reserve are trying to do. As you can see during the 70s, right? There's a interest rate cut when the economy is not doing well. Recession, this gray area means recession. And another interest rate cut. When you cut interest rate, you saw earlier in the inflation picture, you tend to support the general prices. And this is another thing that I referred to earlier is the policy maybe it should use more consistency or persistence in terms of policy making because of that problem that I referred to earlier. It takes time for the interest rate to take effect. Okay, another thing that we should observe is that right now the interest rate is not moving around as much as 70s, 80s. There's a long period of time during 90s to 2015. That is also a period when China experienced phenomenal growth, economic growth, which supplied to the Western country really cheap consumer goods, right? People can go out and buy stuff very, very cheaply. And that actually contributed to this kind of stability. And are we going to go back there? That's another question that we should ask. So, okay, right now, this is where we stand in terms of Fed funds rate. The debate right now is, should the Fed become even more aggressive? Should it just go up like that? Or should it go slow? And how long should it wait until it changes its stance from very aggressive hike of interest rate to wait and see kind of move? Okay. This is not U.S. This is ECB, European Monetary Union. Their policy rate follow U.S. move from actually negative to positive territory just not long ago. So they acted later than U.S. With a long period of time that their rate, interest rate, this is actually a nominal interest rate, was in a negative territory, which is very unusual for, you go out and borrow money, they pay you, basically. That was negative, what the negative interest rate means. If I want to go back, I would also want to point out this period. That's 0, right? That's the lowest one that the nominal rate can go. But ECB actually went further. They went negative. This is usually what we refer to as lower bound. When you hit the bound, the Federal Reserve in the US tend not to go any further. You just stay there. This is extremely accommodative. Right? So later when I show the yield curve, this is the short-term one. At this point, the Federal Reserve can also try to find a long-term rate to try to suppress it, so that the business can go out and borrow money in a more favorable way. But you can see, when you're hitting lower bound like that, that's unusual. That's more like a trap than anything else. If we are able to bounce out of it, even though it's painful right now, maybe this is actually a good thing. Okay. So ECB also trying to be aggressive. Now this week, this last week, UK, Canada, not Japan, some other countries, like even Vietnam, China, all trying to raise interest rate because their currency has been dropping very, very much and a lot. So this is also a period could become very dangerous. People are engaging, the central bank are engaging in competitive hike of interest rate. So that will cause the cost for capital globally to rise to a level that might be very suppressing to the global economy. 这个 data 是很有意思的，就是说我们现在 the current period we know what's causing the inflation problem largely is due to energy, right? There's an energy shock, there's a war going on, and especially for the natural gas, in Europe, it's a big problem because what was the big problem for Europe is they depended on Russian gas. So because of the war, because of the sanction that Western country put on Russia, they shut off supply to European country. So you can see, 这个是美国的情形啊，这个环线基本上还是在10以下。Lower than 10, but in European country, this natural gas prices has been spiking and stay at a very high level, and that obviously is a huge push for inflation. So over there, it's quite visible, and this is one aspect of it that caused us to think that the European picture may not be as easy to control as the U.S. 但是呢, after the Federal Reserve signal, because they move earlier than the European central banks, after the Federal Reserve signal a tight monetary policy by increasing interest rate earlier in the year, we saw that the gasoline prices has actually been dropping quite a bit. I remember during the summer we went out for a trip. The gasoline prices was like $5, more than $5 per gallon. Now it's like below 4. You can see. So that's quite a bit of a drop. However, when you compare that to before the jump, it's still quite a bit higher. So there's still quite a lot of energy, inflationary pressure from the energy front. 然后其他一些现象我们也需要another thing to pay attention to what's causing the inflation pressure is the shipping costs, right? We have a lot of consumer goods from China or from other Asian countries. And you can try to look at the freight costs from Shanghai to LA. Last year there was huge problem. I remember visiting a small farm. The owner of the farm spoke to us saying, the shipping cost is just eating up all my profit margin. I cannot continue with my business anymore. And that was during this period of time. 这个从上海到 LA 这个 port 那个集装箱的那个价格，就是到了不可忍受的地步。那么后来这个就是 supply chain effect. Gradually over time, it has come down. It has come down a lot. But would that be enough? We don't actually know. 这个 picture 呢 is from 2000今年的啊，今年最近几个星期的。So it continued to drop from this one. Okay, that's the freight cost. 就是集装箱的那个海运价格。另外一个就是讲这个 commodity index, including energy, oil, and gas, and natural gas. They still continue to stay kind of high. So basically, the price pressure from the energy, high energy prices, we cannot ignore it. There's certain aspect of it has been improving, but there's still a pressure coming from energy market. The other thing that we can see that's going on will affect the outlook of inflation is what's happening with the mortgage market, with housing prices. And with housing, the mortgage rate is a crucial rate that we ought to look at. 最近几年，这个 mortgage 相当的利率相当低，对吧？如果是去年2年前 refinance 的话 the rate was very good, right? Lower than 3%. But after the Federal Reserve signal, the interest rate change, it spiked up very quickly. And this is going to have a huge impact in the housing market, as you can see in this picture. What this is showing is the blue line and the green line is what we're trying to look at. The green line represents new home sales from business point of view, from economic growth point of view, new home sales is much more important than existing home sale, right? Because every new home you build, you employ a lot of people, you create a lot of jobs, and giving the economy a lot of push. And new home sale from earlier to 2022 here has been declining steadily. And that pretty much is due to the higher mortgage rate because employment picture is still okay. It's the financing aspect of it causing a huge drop. This picture is the starts. New home start is even more forward, and that has also been dropping quite dramatically. The red line is somewhat of a overall picture of the housing economy. And what this picture also trying to show is if you want to use the leading sector of the economy, the housing sector, trying to forecast when the US economy is going to enter into recession, basically you can use that throughout using the historical data. Let's say this is peaking, right? It takes quite a bit of time before the economy actually enters into recession. So if you use that kind of relationship as a way to forecast when the US next recession is going to occur, it's probably not here, not now, but sometime later. Maybe next year, 2023. Right now it's the consensus that probably the US will enter into recession next year. The other indication, very quantitative way to forecast recession is what we call yield curve. Okay. Yield curve is a very important information. Interest rate curve. This is 1 year ago, the blue line, upward sloping. This one is only a few days ago. Okay. When Federal Reserve increase their short-term lending rate, borrowing rate, they affect this point, short-term rate. So right now it should be about 3, a little bit. But then the rate for 3 months, 6 months, 1 year, 2 year, 3 year, they all have different rates. Okay. So when you plot this thing together, it forms something what we call yield curve. Normally, when the economy is expanding, the longer contract you enter into, the rate should be higher, which is the upward sloping one. But when part of it becomes downward sloping, what we call inversion, that's actually a signal for recession. And there's no theory behind it. People just look at historical data and look at these two yield differences, tend to forecast recession better than housing market. Okay. So yield curve inversion is another strong signal. Right now it's inverted with pretty high amount. So this is another indication maybe in 1 year or so, the US is going to enter into recession. Another thing I want you guys to observe is that 1 year ago, this is a happy interest rate, right? The low rate is hitting the low bound. The long rate is only about 2%. What was the expectation of inflation during that time last year? Inflation, long-term expectation of inflation, Federal Reserve tried to control it to around 2%, right? 2%. So the short-term one is higher than 2. What that implies is the real rate of interest is actually negative, which is very unusual during that period of time. Right now, more or less, the real rate of interest has been above 0. That means it actually makes sense for you to lend money, right? When you lend money, you want to have some real return instead of being eaten up all by inflation, right? So this has actually become more normal than this, right? So even though we're entering recession period potentially, but it's actually in some way it's a normalizing picture. 那么 the inflation rate stay high, as I mentioned earlier, in August. And most of the contribution is from the left-hand side. These are all energy related. Year over year, the rate is like 54%, 44%. Energy services, they just shot up a lot over 1 year period. But in August, the market was spooked because of this. What this is showing up as an emergent, potentially important driver for persistency part of the CPI is housing and rental. Rent has been increasing, and that potentially will not stop quite easily. Not like energy, you know. If you have more supply, it's going to drop. But housing supply takes time. Usually you build an apartment, probably takes a year to build it. And people continue, the labor market continues to be good. So the rent and housing, that could still be a problem. And that's probably why the Fed decided to hike interest rate the third time. So this is something to watch, is the emerging driver, the rental and the housing. However, the good news is the supply is also catching up. What I'm showing here is multi-family units, right? The single family has declined, but multi-family is the apartments. People, you know, the builders see that rent has better payoff, so they go out to build more apartments and continue to let's see. Oh, okay, this is plus 2+ unit. This is the single family. Okay, single family started to drop, but the multi-family units continue to rise to the record. So that's potentially, you know, on the supply side, is a good news for the rental market. And labor market is another area that the Fed and economists focus a lot of attention on, especially the job opening gap. Okay, here what this picture is showing is after the 2020 spike of unemployment, the unemployment numbers has dropped steadily. Those unemployed people are much below the job available, okay, to the point that the ratio of job opening to unemployed is 2. That means the job is plenty, right? People want to have a job, you can have a job. So the employment, the labor market is still very strong, very healthy. Even though there's some debates around, you know, exactly what is measured. There might be a lot of people, for example, potential supply to the labor market due to long COVID. People are holding off. Maybe they will enter later. We don't know. So, but this is a red flag for those people focusing on inflation, because this is not going to allow the labor market to soften very, very quickly. That's also a supporting argument for the Fed to continue to hike interest rate to the point it probably going to cause a recession in order to cure the inflation problem. So there's a lot of data that we all need to take into account to come to grips with what's going on. Now, as I mentioned about the 1970s, right, there's this expectation problem, right? Another piece of good news is, according to the survey of Federal Reserve Bank of New York, that consumers' expectation of what the inflation is going to be, outlook, is rather steady and dropping, which is a good sign, right? People are not expecting, you know, that you go to Costco is going to continue to see price rising from the typical basket, the number of things that they're going to buy continue to go up higher and higher next year and the year after that. That's how people expect, how people project their price expectation. On the gasoline price front, we see that it has been dropping, has been stabilizing, and housing prices also not expected to rise, but rather to fall sharply. Another piece of information that we can go look in terms of measuring consumer or investors' expectation of future inflation is something what we call forward inflation expectation, where you can extract from traded instruments, okay, financial instruments, you can extract how investors project their expectation. And that picture is also rather stable, around 2%, slightly higher, using the 5-year and 5-year forward rate. Basically, over the next, on average, over the next 5 years, the average rate of inflation is not much more than 2%. So that's another good news. Coming back to the lesson from 1970 is that if you have a stable expectation, maybe we're not going to see people entering into competitive bidding for resources, like for labor, for commodity, right? That worry is not as much. So right now, after seeing all this data, all these things, the focus of the debate right now going on around the topic of stagflation is mainly as always, there are two different camps, right? On the hawk side, I cited a lot of well-known economists, including Larry Summers, Olivia Blanchard. These are people who have served in the government or World Bank, IMF, and they have been engaging in either in the private sector or the public sector, very highly regarded economists who have written papers in this field. A lot of them is holding very strong views about inflation. So that camp, we call inflation hawks, is that their view is that inflation has been too high and will continue to be high unless we have a recession. And that recession could be a number of years and 7.5% unemployment rate. That's according to Larry Summers. Very, very hawkish, right? That's one side of it. And his argument is basically the job vacancy picture that you saw. Labor market is too strong that people are going to continue to earn a very good living, higher and higher wages. You can't possibly think that the general price level is going to come down to 2% level over 2 years or something like that. The other camp, what we call inflation dolls, are people like Nobel Prize-winning economist Paul Krugman and the Goldman Sachs economist Hatzius, and this Moody's economist Zandy. They argue that soft landing is still possible. Meaning soft landing, meaning you control the price level to the point not causing recession, not causing a spike in unemployment. It's still manageable. And they cite reasons like, the initial price pressure was caused by pandemic, and pandemic is nearly over, right? There was a supply chain problems, but we see it in the data that the shipping cost is decreasing, oil shop is decreasing, and the housing are easy, right? People, when you go out to buy a new house or existing house, you're not going to pay top price for it right now. And those things, when
especially housing, when it gets started, it'll continue for a while, right? Before it stabilizes. So you're gonna see it continue to soften. And another argument is from this camp is Fed policy needs time to work. They have already hiked a few times. They have already tightened the money supply. And that needs time to work, and it will work. Plus, inflation expectation is quite stable. So both camps have some points that they make. Is both have very strong belief. And then in between, this people and the Fed as a whole seem to be, try to adjust their position in between these two camps. And I'm just laying out those there without really injecting my own view of how this is going to play out. Actually, most of people don't know. Financial markets seem to be influenced by one view versus another from day to day. The other things that I think personally we should look at, we should pay attention to is the strengthening of dollars versus other currencies. What that indicates to me is that because the Federal Reserve was early in hiking rates, and that the U.S. economy is in a relatively good shape, even though we have high debt. Labor market is strong. Technology innovation is also going strong. That investors tend to want to put money into U.S. dollars. So the dollar has been strengthening a lot this year, continue to do so. The flip side of that is other currencies are all dropping, and that could cause a problem for them in terms of how they want to be able to purchase the things that they need from outside. These also give us a reason, an indication that maybe U.S. will enter into recession earlier, but will also lead us out of the recession earlier than the other economy. So here's my little take on the whole picture, is that this is actually a very difficult subject. Too many things to consider, and we never have enough information, enough policymakers. Even policymakers may not have sufficient information to really have a good view. High uncertainty also due to the lingering effect of the pandemic, due to the ongoing war that we're having between Russia and Ukraine, and that's affecting, in particular, the energy market. Not only that, on top of that, it's causing a geopolitical realignment between different countries. Potentially, right, we are seeing a new Cold War developing, and that could affect how countries produce goods for the U.S. consumers, right? And so there's positive, there's negative on the inflation front. I am actually leaning towards the second camp because of the data that we're seeing from the financial market. It seems to be more convincing to me if I see it from the financial market, from the trading, from people who are willing to put the money where the beliefs are, that the inflation expectation is more or less stable, that we see early signs of the pricing pressure coming down, that maybe it's manageable. Plus, the Federal Reserve have acted not as early as I would like to have them do, but they acted, they corrected their initial stance. So maybe, given time, it'll work. And so, in conclusion, I think that U.S. may be in a better position in terms of being able to manage this stagflation issue. If it happens, maybe it will be short. If it's short, then it's not a big deal. But if it becomes a long, prolonged problem, then it's a huge problem. The risk of that in Europe is much higher because the energy independence issue. US is more or less energy self-sufficient. We are actually exporting energy to Europe. China, however, I do not see a huge inflationary problem, but as what I mentioned in the last talk, last year, the structural issue of China is a big problem. And I can see a long period of stagnation, basically meaning the lost decades, maybe 1 decade, maybe 2 decades, that China may repeat what Japan had, the problem Japan had during the 1990s. Long period of stagnation. Basically, the economy seemed to be not going anywhere. And old problem may pop up, may get addressed, may be not effective at all. So 3 different continents, 3 different major economies. The picture in the US may be slightly better. If that's your bet, then you shouldn't be, on the sideline. Maybe you should put certain investment in the area that are more promising. So my thinking would be you stay with US, but you need to have this hedging mentality. The volatility might be continuing to be very high. Therefore, you want to have a long-term perspective when it comes to investment. You probably don't want to have a whole lot of short-term trading, and be very conservative in terms of your leverage, in terms of your trading activity. If you put in a lot of leverage and then market tanks, that's a double whammy. Certainly, we don't want to do it during this time, right? Even though inflation could be high, cash is actually not so bad to hold. Value will decrease because of inflation, but potentially it give you option to invest when the opportunity arises. And I think if my take is turn out to be right, then opportunity will arise as the Federal Reserve signal easing on the interest rate hike. At that point in time, market could rally afterwards. So, and in terms of individual, picking investment, pricing power in this kind of environment is key. Because generally speaking, everything seems to be going up, and if a business can or cannot do well, depending on how well they can pass on the prices. The other thing too, people don't talk about it very much, is consider shorts, right? If market tend to drop, then it actually makes sense to put on a short position or buy put options to protect your position. And I have already seen people talking about buying bonds. That's from bond, so-called bond king, right? When interest rate was like rock bottom, hitting low bound, and it actually negative real yield, nobody wanted to buy bonds. It does not make sense, it does not pay, right? We got eaten up by inflation. But now, when you see a positive real yield, it starts to make sense to buy bonds. And if the economy get out of this current trap or flunk, right? The Federal Reserve could signal easing interest rate hike or even decrease it next year. At that point, the long-term bond is going to perform very, very well. So, at some point becomes interesting to buy even long-term bonds and the munis, things like that. And stock may recover. This year, high-tech stock is no, right? It's big corrections, more than 20%, nearly 30% down drop. But U.S. high-tech technology companies continue to be the leader of the next wave of economy. So at some point, I think it makes sense to get back to the actions. So that's all my talk. Thank you very much.
还有什么问题，大家都要讨论一下。
3:30. All right. Okay.
那个听说您是做那个evaluation investment， 可以 disclose 一下你今年的 return rate, last 2 year return rate, last 5 year return rate。
Maybe I'll disclose.
因为如果就是说我们很多这个 knowledge 如果不能 apply to action，
Yeah.
translate
Okay.
to achievement。
I'm not here to solicit any money or whatever, but I can tell you over the last 10 plus years, I have been doing investment on my own. After we moved to Lehigh Valley, and I have been managing small portfolio for friends and families. I'm not taking any outside money, and has been doing quite well. But this year was not a good year. So this year, right now, as we speak, this week, I went back to negative, but not a huge amount.
只要比标普500好，那就是好的。我们做 benchmark， 对不对？
Single digit.
因为如果我们想就是说，如果好的话，我们大家都想学习，因为我们想就是。
Right. Okay. So what I'm doing this year, initially, I have a lot of long-term investments in good consumer names, in large cap technology stocks. So that was hammered pretty badly, right? But I did not want to liquidate my position. I'm not a short-term trader. But I did increase my weighting in energy stocks, particularly natural gas. Because that was an area I didn't touch for many years, but this year is very different. 今年这个 energy makes sense， 因为这个战争的情况，因为这个 oil supply 的情况，还有这个可能 regulation 也会有所放松。So performance doesn't really tell you the whole picture. You can talk about 10 years, even 10 years probably will not help you deal with the next year. So my investment philosophy is trying to be as conservative as possible, but if I see a clear picture, I would not mind to go very aggressive, to leverage up, because it's so easy to borrow money, right? But right now, I'm not just trying to stay away from any sort of leverage, but I do have some shorts. Last year after my talk, I put some money where my talk was, short some Chinese concept as well, and I even shorted U.S. Treasury, which helped, but not as much as I would like. So, yeah, that's good. That's about it.
我觉得即使是说老温赔钱了，我觉得他这个我们在说的都是一个 idea 或者一个思路，就这个思路可能对于每个人是不同的，就是每个人个人状况是不同的。
而且investment的话是 long term， 你可能说看到这2年的话，它是有 loss 或者是 stable， 但是它如果是 long term 的话，你看10年或者20年的话
strategy 上它是对的。
If you have a longer horizon, short-term loss doesn't really matter as long as you can manage through. Right? What would cause a real problem, from my experience, is you have margin call, where you when you have to liquidate your position that you like, you're forced. But when economy or financial market, when you panic, went into panic, the margin call is something that can kill you. Especially during those difficult times, you needed more ability to borrow money to cover your positions. But those times is when the brokers tend to increase the margin requirement. They have no help at all. 他们就可以说是落井下石的那种人，那种这个机构，就是你最需要帮助的时候，他跟你说你必须怎么样，所以 margin is something very really manage very carefully.
你对这个I think you said the inflation will be controlled within 2 or 3 years.
Yeah.
And actually that's really bad for what I'm thinking was really bad because currently it's like every per month is 8%. And even I reduce it to 4, let's say cut it in half. In 2 or 3 years it will be the price will be coming easily 50% more than what we have now. Nobody can afford it. I would say 99% of the people inside this room will not afford it. Cannot afford it.
So we're talking about the rate, right? Inflation rate. You're thinking, okay, 2%. When it comes down to 3 or 2%, but price level is still high, right?
It's still high, very high.
When you go to Costco, you're still buying a higher. Hopefully, your wage will catch up, right? They're giving raise.
It's not possible. You can increase your rate in 50% in 2 or 3 years. It's not possible. I would say it's.
What did you say? Increase to 50%?
I mean, like every month you have 8% price increase, and after 2 years it will be 50.
No. That's annualized.
Annualized?
8% is annualized.
Oh, that's annualized. Sorry.
Not every month. That would be
So
crazy.
I'm not learning this. Okay, 8%.
Yeah. It's not that much.
So it's annualized.
Annualized rate. So if you look at the gasoline price, that would be a good example. $3.65 per gallon. You can probably afford it, right? Relative to 2.5 a couple of years ago, it probably is going to continue to drop.
I always feel like quite pressure right now.
Yeah.
And
Yeah.
do you think the policy makers they can afford this? I mean, there will be a lot of objections.
For the poor family, for the lower income people, it would be a problem.
Even for knee level, it's pressure.
Yeah, I mean, when you have inflation, it's usually a problem. But if it translates into wage gain, then hopefully it's not such a bad problem than losing job, right? So that's why. Yes.
So you talked about like wage things and price will go up. I think eventually wages will catch up.
Hopefully,
But
not necessarily.
because you sort of talked about the 70s versus now and so forth. But politics is very different now than it was back in the 70s when I was growing up. Now they're not talking.
Right, the two
They're not
party
working
never works
together.
together.
So how much does politics and the sort of difference between now versus the 70s come into what you were talking about?
Well, we're now in an era that's very polarized, right?
Yeah.
Right versus left. And the Fed, as far as I can see, is probably the entity that are really managing the economy.
The adults.
And I don't know, I mean, naturally, the Democrats are more favorable to the labor, to workers, right? They want them to have more bargaining power. They are more favorable in terms of, forming unions and want to have them have a better way to, more powerful tool to deal with the capital side. With the investors. Right? So that's a big fight. But I also see things changing. The Republicans traditionally tend to favor businesses, tend to favor capital. But do you see that anymore? I mean, is there now?
In some cases, no. As long as they agree with what they say on other things.
Right. So certainly the picture has been really changing a lot. And
guess I was just wondering about the difference, because you were talking about the 70s versus today,
Right.
and we're making a lot of those
Yeah.
comparisons. Thank you.
But I think more favorable climate right now is, it seems to be that policy-wise, is people have learned lessons and tend to be more consistent with what they are doing. And that's a good news. And if you see that the current administration tend to listen to economists, tend to listen to more rational argument more than the previous one. Previous one, we don't know what kind of policy, logic they follow. Only thing they seem to care about is providing tax cuts to corporations and to, wealthy families. But when you cut tax, you increase the deficit. How does it trickle down to the economy is something that nobody can establish any evidence to. Corporations, when they have tax cut benefit, they tend to what? Not to increase their investment, but buy back their stocks, pay out more dividends. So I like to see more consistent type of, more rational type of policy making. And on the Fed side, I have more confidence that they are probably going to do the right thing. Maybe they're going to make some mistakes, but they are quick to correct their mistakes, which is fine by me. People make mistakes, right? Plus, the environment is changing so rapidly. You got to allow some margin of error. So I can see that U.S. may be doing a better job handling the current episode of stagflation problem versus 70s. So, 70 was new, right? It was new, so they didn't really have a framework. Now we have a framework. This framework not only was developed during the 1970s, but also enhanced during the Great Moderation period, also during the financial crisis period, and people have learned lessons from the Japanese experience, how to fight not inflation, but also deflation. Those are very valuable lessons. And I can see that the Fed had observed all of that in terms of their thinking, in terms of how they provide forward guidance, how they set policy. So it's more consistent.
What they can do, their only tool they have is the rate. They can only increase the rate. What else?
They can also control the money supply, how much money they want to print, and M2, M1, how much money they want to lend to the banks. They're allowed to circulate. Another thing, have you heard of quantitative easing? Quantitative tightening is, right, QE is born out of the financial crisis, where the Fed actually actively managing the longer term interest rate by buying and selling treasuries, asset-backed securities, mortgage-backed securities. Basically, they act like investors, but it's just a huge investors. So if the market needed accommodation, they just buy up a bunch of stuff so that investors can free up their holding to the economy. So that's one tool. Several tools. The other thing is they can try to guide markets expectation, right? Investors, corporations, and consumers, investors make decisions based on their outlook. If the Fed can impact the outlook by talking, right? By setting expectations, they can affect, how the economy is going to perform. So many of those is plus regulation. They can actually, ask how the bank should hold their capital versus the risk that they are taking on. So the regulation side is actually quite important. one example is right now we don't see a lot of worry about financial crisis developing right now in the U.S. market because these banks, after the 2008, 2009 crisis, they are asked by regulators to hold enough capital, enough equity on their balance sheet so that they have enough cushions to go through recession if it hits, right? So those are all under Federal Reserve control. I can see as at least 4 major variables they can play with.
But now they only just doing the rate.
Yeah, I know.
So the chief of IMF recently just said that China has not done enough to help with the global recovery, economic recovery. Now, one of the things is probably referring to they still have a lot of American debts. Do they really have that much of an impact on the global economy by buying American debts?
I don't think the buying treasury, I mean the holding treasury, China is decreasing the holding, trying to diversify, partly due to very inflammatory talks between two governments. Right? I don't think that impact is that big a deal, by impacting the treasury market. Federal Reserve can counter it if there's some kind of liquidity problems or purchasing problem. That at the most will affect long-term interest rate. A larger problem that I see from China's impact is really this supply chain, the manufacturing, whether or not China's domestic economy is doing well and continue to provide the global manufacturing power that we can all benefit from. The COVID restriction that China is imposing on itself right now, still after 2 years of pandemic, is a problem. Is going to cause a lot of headache for consumers, just because the type of product that China used to churn out may not be there when we need it to fight inflation. So maybe that was something that people were referring to. If U.S. and China get into some kind of conflict, military conflict, then you can see that problem getting worse, right? And it become 2 continents, two islands, and U.S. will try to circle China's economy, try to choke it, and that will become a huge problem. Hopefully that won't happen. All right, thanks.
谢谢大家。